Welcome to the Explainer. Today we're jumping right into the world of GST, specifically to demystify the letter of undertaking, or LUT, for digital product sellers. Look, if you're selling digital goods online, tax compliance can honestly feel like a massive maze of jargon. But we're going to clear all that fog right now. Here's our roadmap for today. First, the digital seller tax dilemma. Then, exporting without paying IGST. After that, we'll look at 3 real-world scenarios, give you the ultimate LUT cheat sheet, and finally, cover platform rules and your next steps.
All right, part 1, the digital seller tax dilemma: to LUT or not to LUT.
This is basically the million-dollar question keeping digital creators up at night. Do you actually need to file a formal letter of undertaking just to sell a digital planner, some software, or a Canva template online? It sounds way too formal for a quick digital download, right? Well, the short answer is no, it's not always mandatory. It entirely depends on where your customer happens to be sitting and how the government classifies your specific sale. So to figure this out, we first got to define what you're actually selling in the eyes of the law. Under GST, digital products, your ebooks, software, online courses, aren't just simple digital goods. They're usually treated as OIDAR services. Yeah, OIDAR. It sounds like a sci-fi villain, I know, but it stands for Online Information and Database Access or Retrieval. Or, depending on your setup, they might be classified as an export of services. And this categorization, it's heavily dependent on your business model and platform structure, because once you get slapped with that export of service label, a whole new rulebook opens up for you. Moving on to part 2, exporting without paying IGST and protecting your cash flow. So when you make an export sale, the government basically gives you 2 paths. Option 1, you export with an LUT on file. The huge win here? 0 IGST payment required upfront. Option 2, you export without an LUT. And if you go with this one, you have to pay the IGST upfront, out of your own pocket, and then go through the absolute headache of claiming a refund later. And let's be real here. Claiming a GST refund isn't just clicking a button. We're talking months of follow-ups, endless paperwork, and just sitting around waiting for the tax department to process your claim. The major takeaway here is that an LUT is definitely not just some boring bureaucratic tax form. It's a critical tool for protecting your cash flow. Most online sellers jump on the LUT option. Why? Because as a digital business owner, the absolute last thing you want is your hard-earned working capital totally blocked in a slow government refund process. The LUT basically acts as your formal promise to the government that, hey, this is a legitimate export, which lets you completely bypass that upfront tax hit. Okay, part 3. 3 real-world scenarios so you can find your exact seller profile. Let's look at scenario 1, the Etsy exporter. Picture this. You're selling a slick digital planner on Etsy. Your customer's chilling in the USA, and you're getting paid in US dollars through Payoneer or right into your bank account. Because your buyer is outside India and you're bringing in foreign currency, this is almost always treated as an export of service. The verdict? You absolutely need to file an LUT if you want to export that planner without coughing up upfront IGST. But on the flip side, we have scenario 2, the domestic seller. Say you're selling an Excel invoice template, but this time your customer is located right here in India and they're paying you in rupees. This isn't an export, it's just a standard run-of-the-mill domestic sale. So the outcome is completely different. No LUT required whatsoever. You just follow the standard GST rules for this transaction. Easy. Now, what if you're just getting off the ground? That's scenario 3, the micro seller. Let's say you're exclusively selling digital products online, but your total yearly turnover hasn't hit the 8 lakh rupee mark yet. In this situation, getting a GST registration isn't even legally mandatory for you. And since you're not in the GST system, guess what? An LUT is also not required. But, and this is a massive but that you really need to pay attention to, even if you're a micro seller making under that 8 lakh limit, if you decide to voluntarily register for GST, maybe you want to claim input tax credits or just look a bit more established, you have officially entered the chat. Once you're in the GST system, those export rules immediately apply to you. So if you're registered and selling to a foreign buyer, you're right back to needing that LUT to avoid paying IGST. Which brings us to part 4, the ultimate LUT cheat sheet, your new go-to matrix. Seriously, take a second and screenshot this. It brilliantly breaks down exactly when you actually need an LOT. Selling to an Indian customer? No LOT needed. Got a foreign customer and want to export without paying IGST up front? Yep, file the LOT. Foreign customer, but you're totally fine paying IGST and waiting for a refund later? No LOT needed. And if your sales are so low you don't even need GST registration? You guessed it, no LOT.
Keep this handy, it's going to save you so much second guessing.
Finally, Part 5, Platform Rules and Next Steps, or the Aggregator Reality. So, if you're using foreign platform aggregators like Etsy, Shopify, or Gumroad, you're playing in a very specific ecosystem. These platforms collect the cash from your foreign buyers and then wire those payments from outside India straight into your local bank account. Because of how this international money flows, the GST department might just treat your sales as export turnover. For these exact situations, having an LUT becomes incredibly common and honestly highly necessary if you want to dodge that IGST payment. But remember, these rules aren't just one size fits all. The GST treatment of your digital products can swing wildly based on 4 massive pillars: your specific platform structure, your exact invoicing method, the physical flow of the payment, and where your customer is actually sitting. Literally, just a tiny tweak in any one of those 4 pillars can flip your business from a domestic transaction to an export of service, meaning you go from not needing an LUT to absolutely needing one overnight. Since these variables get complicated incredibly fast, your absolute best next step is to take all this to a professional. Always consult with a chartered accountant. This explainer gives you the solid foundation, the right vocabulary, and exactly what questions to ask. But a CA needs to look under the hood at your exact payment flows and platform user agreements to make sure your business is completely protected. Honestly, don't play guessing games with the tax man. So, I'm going to leave you with this final thought to chew on today. Based on exactly how your specific platform handles money and invoices right now, is your digital product truly an export of service? Are you currently using an LUT to protect your business? Or are you accidentally blocking your own working capital by paying taxes you literally don't have to? Take a deep dive into your metrics, ask those hard questions, and keep your cash flowing. Thanks for tuning in to this explainer.